Hello, and thank you for joining us today for Learn Idaho's community education session, Dispelling the Myths of Reverse Mortgages. My name is Dara Ray, and I am the president of Learn and founder of My Care Companions and My Data Diary Family Information Management Solution. I am pleased to welcome with us today Steve Cox, branch manager from Fairway Independent Mortgage Corporation, as our educator. Just a reminder of our disclaimer. This content is provided for general informational purposes only and is not to be considered legal, financial, or health advice. Please consult with your own legal, financial, healthcare, or other service provider before taking action based on this information. As I mentioned, it's my pleasure to welcome Steve Cox, branch manager from Fairway Independent Mortgage Corporation, as our educator today. Steve, would you take a moment to introduce yourself and tell folks a little bit about your background and what you do at Fairway?
I would be honored to do so. Thanks, Dara, and welcome to the Learn community. Yes, my name is Steve Cox. I'm technically an Idaho native. Been in the mortgage industry for just over 2 decades. I am married. I have 2 adult daughters. Fortunately, they're both in the Boise area. One of them works in the business with me, as well as my wife, and the other one's in real estate. So mortgage and finance and real estate very much a part of our conversations at home. I get into the mortgage business, like I said, a couple decades ago. I've always had this incredible passion for finance and housing. I believe it's a way to build wealth, and I've been at Fairway since 2014, and then specifically we're going to talk today about home equity conversion mortgages, which the most common street name is a reverse mortgage. And I started doing reverse mortgages. Actually, the first one I did was back in 2005, but I've been really focused on it since approximately 2016. And I've spent a good part of my personal professional education working in reverse mortgages for probably the last 3 years.
Well, thank you, Steve, for introducing yourself and what you do. And I'm going to go right to your slide deck here, and we'll get started with your session today.
Okay, look forward to it. So, right. One of the things, I'm a part of the Learn community. One of the things with reverse mortgages that come up, and it's something that I describe it as a little bit of a headwind. When it comes to reverse mortgages, is there's a lot of misconceptions, how we've titled this. Some people call it untruths and things like that, but I think misconceptions, because there's the opportunity to address those and put those concerns behind. Part of it, some of the misconceptions may have come from situations with reverse mortgages way back when, that there's a lot of legacy or carryover. But this majority of the reverse mortgage programs are actually what we call the FHA HUD HECM program, which has governmental insurance. But HUD has always looked out for the homeowner, the senior homeowner, and they have made some changes throughout the past 4 decades. When there were issues or problems with the loan, potentially they went in and figured out how can we, correct that. So some of them are rightly so, some of them are just lack of information. And I think it's important that people understand what a reverse mortgage is and what it is not.
Wonderful. Shall I move ahead to your first slide?
Next slide. So what are the misconceptions? So I pulled together about 10. Some may say there's a few less or a few more, but I picked 10. And these are the ones that I feel come up the most common when I'm talking to senior homeowners, senior home buyers, real estate professionals, financial planners, etc. The first one that comes up always is the bank gets your home. And what I will tell you is that is not the case, but we'll address each of these. Next, please. The reverse mortgage is a last resort option, meaning I may have run out of cash. I do own my home, or I have a substantial equity position in it. And it's my only choice to try to find cash flow in my retirement years. Next. Heirs get stuck with the bill. Pretty self-explanatory. We'll expand on that. I might outlive the reverse mortgage. You can see where that would be a valid concern. Reverse mortgages are expensive. That's probably the second after the bank keeps my home, but they're expensive. That would be number two. Next slide. I think we've got 5 more. Not free to sell my home. Like there's some restrictions. That is not the case. You can sell the home at any time. Many people default or get foreclosed upon. My spouse gets kicked out of the home. And unfortunately, that came from some real life situations. Nothing to leave to the kids. Most people want to leave something behind, usually the home. Not eligible for, since I owe on my home, meaning I've got a mortgage today, you do not have to have a free and clear home. So we're going to start with the first myth. Okay, bank gets your home. So I just want to reiterate that is not the case. A reverse mortgage is a mortgage, and it's no different than a traditional mortgage that most of us have had or do have. It is just simply a lien against the property. You get to continue, whether it's in a state, you get to continue to keep title to your home. There is no change in that regard. It is simply just a lien against the home. If you choose to sell the home, the lien just needs to get paid off. So something that we're all very familiar with. And you are absolutely free to sell the home at any time, and there is no such thing as a prepayment penalty. You can sell it 12 months after, you can sell it 20 years after you've had it. So let's move on to number 2. It is a last resort option. And I think this was somewhat warranted because when they were doing reverse mortgages initially, those that tend to look at them were in a financial hardship situation. And there was 2 things that resulted from that. People were in need of finding cash that they did not have. Their biggest asset was their home. And the only way to access the equity or the wealth in the home in the past was you had to take out a traditional mortgage product. But when you do that, it comes with a payment. And that goes counter to what someone was trying to accomplish. And that is their need for cash cannot come with an added payment to go along with that. So we kind of call those needs-based or need ones. And that was partially why the reverse mortgage was started, was to try to help those that may be their single biggest asset. They don't want to sell the home. They would like to stay in that home, but they would like to free up some of that equity. The other option is then those that can use it in more of a retirement planning strategy. And it says post 2015 because we started creating options within reverse mortgages. You do have to be age 62. You can actually have a borrower on less than age 62 if you are married. But the idea came up with the reverse mortgages. You've been paying into that for all those years. You've created this substantial equity position. How can I stay in my house and use the equity in a coordinated strategy? So you could do a reverse mortgage as soon as you're age 62. I may not have an immediate need. My need may be a future need, maybe a known need in the future, or it could be something unplanned. And I would think most of us would have either been involved in personal situations with family members. Usually these needs tend to be unplanned and we're not very well prepared. So the idea of a reverse mortgage now is it can be used in conjunction with other retirement plans and strategies that you have. If you don't use the reverse mortgage immediately, it actually grows over time, and it presents itself as a very flexible planning tool. You'll see more and more financial advisors are now open to using equity in home to try to coordinate a strategy so that the overall wealth is greater at the end than it would be if you never introduced the reverse mortgage into your strategy. So it does still help the ones that need them. The ones that need to plan and can use it in a coordinated strategy, you can use it either way. Heirs get stuck with a bill. So there's kind of a couple of questions you need to ask yourself. is there equity left in the home? And then do the heirs want the home? So this little chart kind of gives you a response to each of those. So if we look at there's no equity left, and do you want to own the home? There is an option for the heirs to be able to purchase the home, and they get to purchase the home at 95% of what the home's value is, not what is owed. With the reverse mortgage, it is an insured mortgage product. And the reason why you pay insurance is specifically for that reason. It is non-recourse, which means the home needs to take care of its own debt. If it cannot pay it off in full, then the FHA upfront mortgage insurance premium will step in and it will pay the difference. But here's the nice thing, the heirs have the first opportunity to purchase the home at 95% and then find their own financing. The other option is if the heirs don't want the home and there is no equity remaining, is you can do what we call a deed in lieu. And basically what you do is you just turn the home over to HUD. HUD will sell the home. They will make the lender whole, and then they'll use the HUD insurance fund to pay the difference. If there is equity left in the home and the heirs do want the home, then all they have to do is simply pay that loan off. They can do it by refinancing and putting more traditional finance product against it. The other option is they potentially might be age eligible for a reverse themselves, and they can turn around and use a HECM mortgage or reverse mortgage to acquire the home. And then the other is if they don't want the home, which a majority of kids do not clamor to move into mom or dad's home, is they can simply sell the home. The net equity from sale is then becomes part of the inheritance, and you can use the funds and do with it as you please, just normal inheritance. So that kind of gives you an idea of what the options are when it comes to that point in time that the home needs to be sold.
And if they do sell the home and they don't want it, they settle the loan and then keep the remainder as their inheritance.
Absolutely.
Right?
Yep.
Okay.
I might outlive the HECM. People do tend to live longer, and a lot of times notes have a term. A reverse still has a term, but the way that this was done was they took life expectancy and then they added a factor on top of that. So technically, a reverse mortgage is not due until the youngest borrower turns age 150. And if you can imagine, we've not had anyone reach age 150. So that is by design, that term is almost always met. So the only remaining requirements for the reverse mortgage is it stays in effect as long as it remains the principal residence of at least one of the borrowers, that you pay the property taxes and the home's insurance as agreed. And if it has any type of homeowners dues, condominium dues, if it's a property related expense, that must be kept current. And then the last thing is you just must maintain the condition of the home. So it needs to remain in good condition, which is the same requirement you'd have of any traditional mortgage, is you must keep the collateral in good condition. Okay. And then the idea is, oh, I'm in this house until I'm 111. Let's say we have another 2008 kind of housing event where you see a significant decline in house appreciation, really depreciation in that manner. It's highly unlikely that we would see another 2008, but let's just say that you do. Because we have the insurance through HUD and FHA, they will guarantee it. So even if you live to be 111, you've never made a payment on that reverse mortgage, you owe something much higher in the scale, the loan balance, but the home value significantly declined or did not really appreciate, you do not need to worry about that gap. That is where the value of having that home insurance comes into play, and you do not need to be concerned that you're going to be responsible for, or you're going to pass a bill on to your heirs. And they can never ask you to depart the home as long as you continue to meet the requirements, or what we call the conditions of the terms of the loan. Number two that I hear most frequently is they're expensive. Well, we always like to use the term expense. Well, is it expensive, or does it have a low value? And what I would say is that the reverse can have high value. And things that are amazing are often not free or not inexpensive because of that value. And then the other thing we talk about is as compared to what? So with the reverse, there's so many alternatives. I can do a reverse mortgage, or I can sell my home and I can rent. Or, so we have trade-offs. And then we have to think about, if we don't employ the reverse mortgage, will I be better off 4, 6, 10, 12, 15 years from now? With the reverse mortgage, the advantage is you never have a home payment. And a traditional mortgage does not offer that. You must pay it monthly. Try not to make your house payment and find out what happens. With the reverse mortgage, we say the payment is optional. So some may choose never to make a payment, and that could be a great strategy for them. Some may still be working. Dara and I were having a conversation, at what point do we retire? Well, some of us may work until we're 65, 67. We're eligible for a reverse at 62. It might be a good strategy to do that at age 62, but continue to make a house payment. Then at some point in the future, if I've not paid my reverse mortgage balance significantly down or off, I would have the opportunity to just simply stop making a payment. And at that point in time, then it's just the balance of my reverse plus the unpaid interest that accrues monthly. And that's the idea behind the reverse mortgage, is that instead of paying interest monthly, which is required, and when I make my payment, interest is paid first, with a reverse, if I choose not to make the payment, it is simply added to the balance of the loan. Second advantage is you never have to worry about owing more than your house is worth. Third is it is a government insured product, so you don't need to worry about some type of a private insurance program coming back and saying, hey, we can no longer guarantee, or we've seen private insurers go out of business because they did not plan well for their claim expenses. HUD is congressionally mandated to carry a sufficient balance in the FHA mortgage insurance to cover not only reverse mortgages, but FHA also offers a great, categorized as a first-time homebuyer program. Doesn't need to be a first-time homebuyer, but HUD, really their mandate is housing. And it helps first-time home buyers all the way through, our last home as senior homeowners. And then the other benefit to the reverse, especially if your house has no mortgage, is that you can basically take the reverse mortgage in the form of a line of credit. And there are lines of credits that we can get today. Even I'm not 62 yet. I can go in and get a traditional home equity line of credit, but if I draw money on it, I have to immediately start to make monthly repayments. The other thing about that line of credit is it is not guaranteed to always be there. If the lender determines that home values are declining, which is what happened in 2008, 2009, the lines of credit, banks and credit unions had the ability to come back and cram down that line of credit, basically decreasing the line of credit availability. And then they could also require that they start making principal and interest payments. With the reverse mortgage, that line of credit can never be closed or crammed down. And the other benefit is, as we get older, any unused portion of the line of credit, it actually grows. So I just say if it's not accruing interest, which means the amount of funds I've borrowed, the remainder is actually growing at the same rate. And that's why this could be a good planning tool where I don't need it today, but I may want it 20 years from now. My line of credit could be 150, 200,000. 10 years from now, that could grow to 320. And I would be able to have a much larger line of credit to use later in life. Maybe I've quit working. My expenses have increased. I maybe lost a spouse and I've lost some household income. I can then look to that line of credit as a place to receive cash. And the other thing is your line of credit is not considered income. When you draw money, it is actually considered debt. So it's not income. You do not pay payroll taxes on that. If you need to draw $1 for goods and services, you can draw $1 from your line of credit as opposed to drawing maybe $1.40 at a 40% tax rate. So those are the things, or the value that the reverse mortgage can give you that more than offsets the initial upfront costs. Let's move on to 6. I'm not free to sell my home. Again, that is, you retain full access to the title of the home. It is, the reverse mortgage is like any other mortgage that you've had against the property. When you go to sell the home, when you go through the closing process, there will be a payoff statement that's provided to the escrow process, and you will pay that off in full. The lien is removed, can be sold to someone else. An heir can take the home, whatever your situation is. You can sell it with no prepayment penalty, and whatever's remaining in net equity belongs to you or your heirs. If for some reason you go to sell the house, you owe more than it's worth, you need not come to the table with any money. The mortgage insurance will take care of the deficient balance. Many people are foreclosed upon. This is a little bit of that issue where it made news stories in the past 20, 30 years. They've made a major change to reverse mortgages in early 2000 and into the around the 2014 timeline, is lenders now must do a financial assessment. And the reason why we do that is we do not want to put someone in a reverse mortgage that they do not have enough sustained income to be able to meet all the obligations to keep the reverse mortgage in place. So again, you got to pay your property taxes, insurance, homeowners or condominium dues, maintain the condition of the property. And if you just don't have the ability to do that, then what was happening is sometimes those that felt in need, they would do a reverse mortgage. It only kicked the can down the road for a period of time. And then all of a sudden they were back in a very difficult financial position, and the only recourse was to let the lender take the home. So now we do the financial assessment, and that has really severely decreased any foreclosures or any significant actions that have need to take place. The other thing is if there's equity in the home and there's a concern that someone says, hey, I'm afraid that if I have access to this money, I may spend it, and then I may be in a situation where I cannot make my property payments, my obligation, my taxes and insurance. They do a provision in there for a loan set-aside account where you can actually set aside, like a long-term escrow, you can set aside a portion of the reverse mortgage proceeds to be dedicated just to pay your future expenses of taxes and insurance. So it gives you that ability to know you don't have to save for it, it's already there. And so it's that issue for the most part has been taken care of. Can a house be foreclosed upon? It certainly can. But I would say that is true of a home with a traditional mortgage. I would say that even a free and clear home, that could be an issue, because if you do not pay your property taxes, for example, at some point in time, they can come after the home as collateral So there isn't really a safe harbor where you never have to worry about that. You always have to keep your taxes and insurance paid up, especially your property taxes. Number 8, surviving spouse kicked out of the home. Unfortunately, some of that happened as well. And that was sometimes if you have a spouse that was not age eligible, they were not on the home loan. If the borrower passed away, then the non-borrowing spouse did not have protections. And that has been changed. So now the non-borrowing spouse is 100% recognized. If the borrowing spouse passes away, it does not cause the note to become due and payable. All that has to be done is the terms of the note continue to be maintained. And that is the non-borrowing spouse simply must remain in the home as their primary residence, keep the taxes, insurance, and HOADs current, and maintain the home. And they are meeting the terms of the loan, and they will never be asked to vacate. The other option is if that non-borrowing spouse is now of age, then they have the ability to go in and be added onto the mortgage. Even you can do it before the borrowing spouse passes away. So sometimes that is a strategy. But if in that unlikely situation they pass away before they're eligible to be added to the loan, it will not require that they sell or vacate the property.
Sounds like that was a really important change that really changed the face of this product.
It was a huge change because the whole intent behind the reverse was to take care of those, in later years of life, and to displace a senior homeowner just because they weren't on the loan was not well received, and rightly so.
And wasn't the intent, right? Yeah.
For the intent, it was just something that was probably not properly thought through.
Yeah.
But provisions have been made. Number 9, nothing to leave others. That is a very common, when I sit down and talk with individuals, they're like, but I really want to leave something behind. Well, what I would say with the reverse mortgage is we fully expect home prices to appreciate over time. If you look back historically for the last 80 years, home prices have appreciated 73 out of 80 years. And 6 of those years, those negative or small appreciation years were after 2008, because we had such a difficult time trying to pull out from that situation. So typically, and there's no guarantee because we don't know when the home's going to be sold, but typically over your lifetime, the home is going to appreciate, and typically it appreciates at a faster rate than the balance on the reverse mortgage, even if you choose never to make a payment. So ideally, you'll always have some equity to leave behind if you so choose. The other thing is if someone has a reverse mortgage, they may conserve and have more cash when they pass away. So they may not be passing a home or a significant equity position, but they may be passing on other assets that are just as valuable. So keep that in mind. You're trying to pass on a legacy. It may not always be the home, but there will be other assets in total that you can leave behind. And like I said, I would much rather, and I think most people would much rather inherit cash than a home that they've got to sell. So typically that is not a concern. I'm not eligible as I owe on my home. So a free and clear home where you have no liens is going to give you the best benefit because you're going to be able to access a substantial amount of its equity. And again, that is determined by the age of the youngest borrower. So you need to sit down with a reverse mortgage professional and they can do a proposal and figure out what that benefit looks like. But even if you do owe money, in some cases, the reverse mortgage can still be an equally great tool in that you may be able to pay off a traditional mortgage that you are making required payments monthly. That may prove to be a little burden to the household cash flow situation. It could also become a strategy to stop making a house payment, redirect those funds that you normally spend to make that repayment, and you can put that into other investment vehicles. You can pay off other higher interest debt. You can try to pay down all your debts. So you can redirect the money and put it in an area where it's going to have a greater benefit for you over the long run. As I mentioned earlier, the payment is optional. So again, that becomes part of your financial strategy. If you have a financial planner, you can always sit down and have that discussion with them. And then the other opportunity is the line of credit, as I had mentioned. That will grow in time. How much it grows depends on what the prevailing interest rate is for reverses, but that you can potentially pay off a small mortgage balance and have a line of credit. So you stopped your payment, plus you've got a growing line of credit that you could use at a later date. So if just because your house is not free and clear, it is still a great option to get with someone to find out if you employed a reverse mortgage, how that might potentially benefit you as well.
Wonderful. Any wrap-up comments, Steve, on what people should do as they think about, if they're considering this, who should they talk to see where they fit and what works for them?
Yeah, Dara, great question. So the one thing with reverse mortgages is when you do a reverse mortgage, there's also a requirement to receive some counseling from a HUD certified counselor. And the reason why they do that is they want to make sure that you receive education, not only from a lender, but from a neutral third party. To me, the reverse mortgage, you need to start at the point of education. You need to understand what it is not, how does it fit into your situation? You plan to sell the house in 2 or 3 years, maybe downsize. I might say, you know what, I would not do a reverse mortgage. I would wait. Because of the expense and the value, ideally you do one reverse mortgage. Is there situations where you do 2 or 3? Certainly there are, because everyone's situations are different. But what I would say when it comes to a reverse mortgage, I would get educated. There are numerous sources of education that are not from lenders, so you can get a very neutral third-party education. You can certainly reach out to myself. I'd be more than happy to direct you to some of those sources. But I would say it starts with education, then you develop a plan, then with you should receive what we will officially a proposal, which will actually take your property, your situation, ages of borrowers, and then you can sit down and you can look at basically a pie chart. You can see how much equity will we retain, because we keep a portion of that equity there because we know if you stop making a payment that interest is going to accrue. So the whole design is that we do not put you in a situation where you owe more than your house is worth. That is just core to the program, and its longevity is for it to continue to make sense for HUD, for FHA, and for our senior homeowners and buyers. So I would just say educate first, be open, maybe consult a trusted advisor if you have anyone that does financial planning with you. And then it clearly becomes obvious, is it something that can be done? What are the benefits? How is this going to help? How, and the other thing I might recommend too, Dara, is I always say, bring people in to your trusted circle. So that could be kids or, someone that, you would want them to know what you are doing. So there's no surprise at the end. So that's what I would say. That would be my initial step, is just get educated, and then you can take the steps after that.
Well, thank you so much, Steve, for sharing with us today some of those myths and how they really don't apply to the product that is offered today, and giving people that first step to education to understand this product better so they can begin to determine if it's something that would work well for them or someone that they love. And as I've shared with you before, I've told my husband when I turn 62, I know what I want for my birthday. I want a reverse mortgage. So,
I'm right with you. So
yeah.
we're counting
So
days.
count down the days. Well, thank you so much. Steve Cox, branch manager from Fairway Independent Mortgage Corporation here in Boise, Idaho. Thank you for being an educator today. Thank you for being a Learn member and for sponsoring Learn in so many ways and supporting our mission to help people enjoy and navigate the joys and challenges of aging and caregiving. If you liked today's session, if you felt it was valuable, we really encourage you to go out to our website and join our mailing list so you can be advised when we have new content on topics related to health, wealth, lifestyle, caregiving, and technology for the aging community and the caregivers who care for them. We do have more than 100 topics in our video library available on demand at www.learnidaho.org/channels. You can find topics related to your area of interest and receive educational sessions from experts in their field, just like Steve. Just a reminder, Learn Lifelong Education and Aging Resource Network has a mission to help people navigate the joys and challenges of aging and caregiving. Our vision is to serve as a trusted source of information and resources for the community, delivered by the community. And our purpose is to provide free education for mature adults, family caregivers, and the professionals serving them. Thank you so much for joining us today, and we hope you will come back soon for another session with us.